The playbook that's worked in the past will very likely not work in the future. A fresh game plan for a new world order in investing is required. The question is, how will allocators adapt? Helping investors save for retirement is an increasingly acute challenge, yet one that is ever more important. And public markets alone may not be able to secure investors' futures. Private markets aren't perfect. They can be illiquid. They can be more opaque. Smaller companies sometimes have more risk than larger companies. But at the same time, there are merits to private markets. There's reasons why investors may choose to invest in private markets as opposed to just investing in public markets. That alternative is going more mainstream. Does a new world order require a re-architecting of risk? Does it require a reordering of portfolios? Based on what the world used to look like, perhaps it does. Because what used to look like is not what it looks like today. The decreasing trend of globalization, the fact that rates have now gone from low to high, and the fact that governments aren't necessarily printing money by fiscal stimulus, all of that means that the investing game on the field has changed. That means that investors may need to think about their portfolio a little bit differently. If the public markets universe is shrinking, what about expanding that to the private markets universe? Now, investors, they have access they didn't have before, whether it's equity, whether it's credit, whether it's real estate, whether it's infrastructure. All of those things are now available to investors. Evergreen funds are a major product innovation in private markets for both investors as well as for companies looking for investment. What do we mean? Well, for investors, historically, they've often faced high minimums to invest into private equity funds. Why? It's in part because of regulatory challenges, but it's also been because of the operational overhead required to support many more investors. Evergreen funds have helped change that. They've lowered investment minimums. They've streamlined a lot of the investor reporting, making it much easier to deliver reporting valuations to investors on a more frequent basis. They've also made it possible for investors to make a single decision investing in private markets. With closed-end funds, investors would have to decide what to do with the capital they'd committed but hadn't yet invested into a fund. They had to keep that capital. What if they needed liquidity? With some evergreen funds, people can invest right away. And in some cases, firms have an evergreen or perpetual fund structure that enables companies to hold their business and continue to grow that business rather than sell it. It's a multi-trillion-dollar opportunity hiding in plain sight. If we think about the investment marketplace, there's roughly $140 to $150 trillion of assets residing in the institutional channel. That's big sovereign wealth funds, that's insurance companies, that's large pension plans, that's endowments. Many of those firms have invested in private markets, some to the tune of 20, 30, 40%. Individual investors, globally, actually represent a similar amount of capital, $140 to $150 trillion of assets. And that's only growing. What does that mean for private markets? Well, individual investors, roughly speaking, are around 1 to 3% allocated to private markets. What if individuals end up starting to allocate percentage points of assets to private markets? Go from 1% to 5%, 1% to 10%. You're talking about tens of trillions of dollars that have the ability to flow into private markets. Many of the industry's largest asset managers, like EQT, are figuring out ways to provide investors, particularly those in the wealth channel, with more options for investing in private markets. This is important because it's emblematic of a bigger trend. It's the transition of funds to firms. Alternative asset management is undergoing an evolution. It's an evolution that's 40, 50 years in the making. Large alternative asset managers, they've gone public. They've had to think about their brand. They have to think of themselves more like a consumer brand and market directly to the individual in ways that they may not have before. They have to help people understand that they invest in companies from data centers to dating apps. We may not realize who's behind that company, but oftentimes the firms powering those businesses and helping finance those businesses, the growth of those businesses, are in private markets. But what that says is these firms are now multi-strategy, they're multi-product, They serve more investors in more places. They're global. They have people on the ground all over. How do you grow a firm from a few hundred million euros to hundreds of billions of euros today? That requires investment. That may require going public, which firms like EQT have done. Why is that important? It's put these firms on a growth path in a growth industry. What does that mean? That means that these firms are now thinking of themselves as businesses. If they're thinking of themselves as businesses, I think it can help us make sense of why, A, the wealth channel is becoming an increasingly important LP and customer for these firms, and why product innovation is so important for these firms as well. Some investors are large, like family offices. They may act like institutions. They may be as big as some institutions. They may have tens, if not hundreds of billions of dollars. Others might only have $100,000 to invest. And that's fine, because now product innovation has caught up and enabled people to have access to private markets in a way that they haven't before. And many of the world's biggest firms realize that they need to be able to serve all of these types of investors. And not only serve them, but serve them well. There are issues with private markets, just as there are with public markets. And I think investors have to be mindful of where private markets make sense and where they don't make sense. What that comes down to is education. Many firms are doing a great job of educating investors about both the merits and the challenges with private markets. Private markets products often have had higher fees than public markets products, so performance is critical. Private markets will need to outperform public markets in order to fulfill its promise to investors that part of the reason why people are investing in private markets is trying to generate outsized returns relative to what they've been doing in public markets. There's reasons to add private markets to an investor's portfolio, but it needs to make sense. They need to be educated, and they need to understand what they're doing, and why they're doing it, and how they're doing it.
And that's us.
Perfect.